The market rally picking up from its improbable reversal on Friday after the initial reaction to the jobs report sent it down. The S&P spiraling below their 200-day moving average. You know, perhaps as the session went along, there was this feeling that it was a Goldilocks report on Friday. And you know what? Wasn't too hot, wasn't too cold. There was solid employment and solid wage gains. In fact, perhaps this could be extrapolated to the entire economy, which has seen pockets of slow but steady expansion, and it remains solid even though there's some ups and downs. So perhaps we've hit the magic formula. Here now to discuss, David Nelson, Bell Point Asset Management Chief Strategist, along with Kevin Kelly, Benchmark Investments Managing Partner. Back in black, guys. We were on the cusp, right? Everyone was talking Friday, trapdoor, you get into that 200-day moving average, and David, the people were predicting complete capitulation.
We've been stuck in that purgatory, you know, and the 200-day moving average has been where we fall into the abyss and people start to panic, and we bought into that each time, and we're stuck in there. Now we have to break that downtrend line that was drawn from, I think, higher than this, about 3-4%.
Right, and again,
higher.
What you're referring to, like these lower highs that keep going. If you draw a line, it's pretty perfect.
Well, we got a flat on the bottom. You got that descending triangle right now. We need to break above that downtrend.
Looks like typically that happens, Kevin, and typically it's a major move. You just never know what direction.
Yeah, it's really hard to interpret and extrapolate from a technical indicator, given the fact that the economy is doing so well. I like to focus on what's happening in the real economy, especially on the industrial and warehousing side, where Blackstone came in today and did over a $7 billion deal buying Gramercy Property Trust after last week's deal where Prologis, the world's largest warehousing company, bought another competitor called DCT. So that's showing that something's happening in the real economy on the warehousing and industrial side.
Does that sense, do you get a sense then that these companies are bulking up, trying to get larger so they can meet new demand that may come in?
Absolutely, because think about this. Jobs are coming back to the United States. Manufacturers coming back to the United States. The economy is so strong and it keeps growing. And the Fed's not even worried about oil. You had the Fed president out of Atlanta today talk about $70. Who cares? You know, the economy's doing well. The consumer's doing well. We're not worried about it.
Stocks seem to know that, though, because we are stuck in that market purgatory right now. And we seem to need something more to break out on top of that. I think part of the problem is that we probably hit some valuation levels that we've hit over the last 25 years that have given investors pause in the past. And right now, we seem to need something more to get us above that.
Although since January, we've seen a sharp pullback in overall valuations, right? I mean, I use the forward PE, and we were over 18, and now we're around 16,
yeah,
which is near historic
But back then,
average.
we had free money, and money isn't free anymore. And the Fed is clearly the elephant in the room as they keep raising rates on the low end, on the short end of the curve. That puts pressure on multiples, so we need to push higher, and growth solves a lot of problems.
It's still not going up. I mean, we're still at historically low levels with this strengthening economy that's going to overcompensate for rising rates. And so I don't understand how we can complain about 16 times forward earnings, especially when look at what's happening. Share buybacks are increasing, dividends are increasing, operating earnings are still going up. I mean, and so yeah, the growth rate of earnings may not be.
Let me ask you guys about something that happened late today, and people never talk about this number. I don't know why, but the consumer credit report came out for March, and credit card use, a credit card went down. The biggest decline in 5 years. Is this, in my mind, Dave, it reflects a smarter consumer that lived through the Great Recession and that's not going to get over their skis like they did before. But for others, that might be a red flag.
I think it's a red flag for some, but I'm on your side of the camp on this. I think consumers are a lot smarter. A lot of them still have fresh in their memory 2008 and the credit cards calling them up and canceling their lines of credit. They don't want to see that happen.
Kevin, I got to ask you about these states.
Yeah.
We've got at least 3 states now saying they're going to have surpluses, anywhere from $300 million to over $1 billion because of the tax cut. Is this evidence of supply-side economics?
This is evidence of that because people know how to spend their money better than the government does. And now that we're seeing that people are more in control, it's actually leading to higher revenues for the states, and it'll lead to higher revenues for the federal government. It's called the Laffer curve. So it was proven in the 80s. It's going to be proven again once we start to see the economic numbers come through.
All right. Hopefully we'll Laffer all the way to the bank. Thank you guys very much. Appreciate it.